Well, welcome everybody to tonight's live stream. Haven't done this in a while, so I'm kind of excited to get to it. And so I'm going to try monitoring all your comments, and I want to make sure that you can hear me. So if anybody is on the live stream now, I'm going to wait till a few minutes before I really get into the live stream. But if you could just let me know if you can hear me, and I'll go ahead and begin the presentation. And so tonight, the main purpose of tonight's presentation is just to talk to you about the markets, what's going on with the markets. As you well know, or you may well know, the markets declined quite a bit last week, and I'm expecting that tomorrow is going to be really rough. If it isn't, I'll be very surprised. Thanks, Vicky. Is that a thumbs up that you can hear me okay? If you give me a thumbs up, I'm not sure if you're letting me know that you can't hear me or not. So if you could just, we can hear you. Thank you, Mark. That's great news. Okay. If you don't hear me very well, just please let me know and I'll try to resolve that. But tonight, what I wanted to do was, because the markets are so unpredictable and uncertain, I guess that would be the biggest thing to talk about tonight, is the uncertainty of the markets. That's why we have such volatile markets right now. And I'm going to share some evidence-based information with you, so it's not just my opinion, because everybody's got an opinion about this. But I'm going to share some, I think, what's going to be valuable information and insight as to what is happening and what you might be able to expect over the short while. And then I'll leave it open to questions, because that is really the main goal tonight, is to just have an advisor available to you to answer anything that's on your mind as it relates to holistic planning. And we can go ahead and just get after that. I don't have a cap in terms of how long I'm going to speak, so I'll talk to you as long as my voice continues to go well. I'm going to try to answer your questions as best as I can. So let's get into some of the information and talk to you about what's going on. Okay, so you might know, obviously, if you've been living under a rock, you may have seen this news conference where President Trump, gave a news conference to talk to us about what the reciprocal tariffs were going to be. So everyone, as you know, in Canada, we've been teased with tariffs for several months now, and it's always been delayed and delayed. And it seemed like Trump was going to delay putting tariffs on Canada until after our election, which is this month. Very, very important election coming up on the 28th of April, to choose a new prime minister. Whatever color you're going for, I'm not going to advocate one over the other. I just simply believe that Trump is really waiting to have a prime minister that can negotiate with him. Right now, the stance of the Liberal Party is to just simply do reciprocal tariffs back. And what else can Carney do right now? He's actually sort of a sitting duck, waiting to see if he's going to be the next full-time prime minister, or is it going to be someone else like Pierre Poilievre? So the question is, Trump is really just waiting to say, who is that person going to be? And I expect, my belief is, right out of the gate, I'll tell you, my expectation is whoever that next prime minister is going to be is going to begin to engage with the United States in trade negotiations to resolve the trade negotiations so we can put this behind us and move on. Really, what's happening is the markets are waiting to have these resolved. And I'm going to show you some evidence right now. So this press conference came, Trump announces, here's where we're going to tariff everybody around the world. And then this happened that day and the very next day. There's only a couple spots on the board. So what you're looking at right now is everywhere in North American markets where you could invest, all of the sectors, and only a couple of them are green. Other than that, everything is red. So if you're asking yourself, where can you go right now and not have a negative return? Well, money market is going to be one, gold will be another, the bond market is going to be another. But if you haven't moved your portfolio before red on the board, don't do it now. It's a mistake to move your money to something else. If you are trying to conserve your portfolio and you don't have a lot of money, then that might be a subject of a conversation. But really, the whole point here is, if you are already in a situation where your portfolio has declined, then what you need to do, and I'll jump ahead here, but what you need to do is you need to put some of your money that you're going to need for the next 6 months. You need to do withdrawal and put it aside. Don't let that money that you need for the next 6 months. So I'm talking to you retirees or your, let's say, pre-retirees, where you know you need to have access to some capital in the first month, second month, and so on. So you need to put that money aside and preserve that cash. You're going to take a hit on the loss. And so one of the things that I've talked to clients about who have other advisors, as you know, some of the clients that I have are just people that ask for me to do plans for, and then the other ones are me, where I'm actually managing money for clients. And so for those clients that I just do plans for, I've had these conversations where I've said, go back to your advisor with the plan I've given you and have a look at your non-registered account. Don't delay taking money out of your RSP. So if you're going to, do an RSP withdrawal this year or RIF your accounts, delay it for a little while, maybe delay that period off until the fall, and go after your non-registered accounts and do withdrawals in your non-registered account. Create a loss. So it's similar to tax loss selling, but create a loss now, crystallize that loss now, because you're going to experience gains in the future and carry that loss forward. So just grab some of your non-registered money now, set it aside in a money market, a laddered GIC strategy, in a bond portfolio. Be very uber conservative with that money and use that over the next 6 months while the markets are going to have to reset. I'm going to get into what does that actually mean. How y'all doing? Can you hear me? Give me some thumbs up. Again, I want to make sure, is there any delay? Is there an echo? Can you hear me okay? I'd love your feedback on that. So I'm going to show you now this slide just to kind of give you a frame of reference as to what has happened the first time and this time with Trump. So that red line is July 20th, 2017. That was when Trump took office. A1 audio, thanks, John. So that red line just represents when Trump came into office. And almost immediately when Trump came into office, he put tariffs on China. There was a trade war in 2017, 2018, and Trump absolutely put tariffs on Trump or on China. And what happened was, just come back to you. What happened was between 2017 and 2018, inflation went up by 1.9% in that 1 year. And then we got into about 2019, and the Federal Reserve in the United States started to be worried about inflation. So they did 3 rate cuts in 2019 to try to stave off inflation. And that was largely because of the tariffs that were going on with mostly with China. And there was some with Canada and some with Mexico as well. And so that was what sort of was leading up. And as you can see in terms of the markets, I'm going to show you this right here. A little busy, but here's what it looked like. On the left-hand side, that vertical red line, that's Trump coming into office. And in the first year, that's that red pyramid pointing up to the inflation of 1.9. So there was inflation. And look at the markets behind that gray area where it says tariffs. Markets were running up despite tariffs and inflation. So the tariffs were actually inflation in the United States. And it got so bad that, 1.9% increase, that the Federal Reserve cut rates. And then just shortly after that, in May of 2019, United States signed an agreement with Canada and Mexico. That's the United States, Mexico, Canada agreement on trade. And you can see what happened to the markets just after that. It's maybe hard for you to see, but especially in the NASDAQ, you see the NASDAQ just after that vertical black line, the NASDAQ, that's that purple line, declined. And so did the S&P 500, and so did the Dow Jones. The only one that didn't was the Canadian, or the US dollar actually advanced, went up. So you can see after Trump signed, or the United States signed an agreement with Canada and the United States, the markets actually declined. So it was kind of surprising. You think the markets would have done well, and yet the markets declined. And then Markets ran up shortly after that. Everybody sort of went, okay, this is the new reality. And the markets began to run up. Now, that circle, it says worldwide health crisis. You all know what that is. I don't want to say the word because they'll cancel my account or whatever, but the markets declined dramatically. And what happened after that, of course, is, as you all know, governments around the world printed money and spent their way out of that mess. And you see what happens when interest rates go down. I'll just go back to that slide so you can see it. When interest rates go down, your asset prices go up. So what am I trying to tell you now is, yes, markets are declining, and the markets are declining because of uncertainty. Nobody really has an understanding of what is going to happen with tariffs. How is that really going to impact? You have economists saying it's a tax, it's going to create inflation, and you have other people saying, no, this is going to be really great for North America, just hang tight, we have to reset everything. So who's right in that argument, right? And because nobody really knows, markets are tanking. And this is just a symptom of uncertainty. Markets never like uncertainty. And when that happens, you should sit still. Do not do anything to your portfolio. It's likely that you have good investments, but because there is virtually no place to go, right? There's where we are today, or Friday anyway. The only place for you to go is to sell your portfolio and go to cash. That's not an answer. To actually take crystallize a loss, and it's not a big loss after all. Markets are not down that much. I think I have a slide here on, yeah, there we are. So these are the market returns as of Friday. There's that vertical black line. It's the reciprocal tariffs that came into effect on the 2nd of April. And you can see the US dollar, that's the top one, the blue line, is up 15% for the year. These are year to date returns, okay? That brown, so I'm going to go top on the legend to the right of your screen. I'm going to go top to bottom, right? So the US dollar is up 15.7%. This is European markets, right, are pretty neutral. They were up quite a bit and then nosedived on the 2nd. The S&P TSX, which is the gold one below, is minus 6%. The Dow Jones is minus 9%. Oil is minus 11%. S&P 500 minus 13%, almost 14%. And the NASDAQ minus 17%. Now, that's because of uncertainty. Do you remember a few years ago where the NASDAQ was down 35%? It went up 40%, down 35%. It's pretty hard to take, but that is technology. And right now we're going through a transformation with AI. Everything is being turned upside down. So it's an extremely volatile time for you to be in the market. So I'm going to get into a little bit of portfolio management to help you to figure out what to do so you're not so unnerved by all this. But it's really interesting. Okay, this right now is a perfect setup for what I talked about in a couple of videos ago about the 3-bucket strategy. You might have heard it as a cash web. The bottom left-hand bucket is where you keep all your cash for 1 to 3 years, 4 times just like this. When the market is declining, and if you had moved your money, all the money you need for the year, so you pre-retirees or retirees, you all need money every single month, right? And you've planned out, you're coming back from the winter holidays in Florida or wherever, and you got to plan out your whole year as to where you're going to get your money from. So I advocate that you should take your entire year of expenses and put that in a money market account or a ladder GIC strategy so that you can be assured that no matter what happens to the market, like right now, your whole year is sitting in a secure spot that you can just do withdrawals from, and you don't care so much. You do care because you have all the other money you have to worry about, and you can make sure that the rest of your money, if you go back to the 3-bucket strategy, is allocated properly according to risk and timeline. So that middle bucket, 5 to 8 years of lifestyle expenses, that's what the middle, when we say bucket, you could have one big, massive, let's say RSP portfolio, and you have a certain percentage allocated to money market, a certain percentage allocated to a securities or funds that have a middle of the road risk tolerance and return profile so that it's really 5 to 8 years you're investing that money. And then the last part is that 10 to 15 to 20 year pool of money that you can be more aggressive in. Like right now, the markets have declined. If you have money sitting on the sideline, not a bad time to go into the market and start picking off some investments for a 10-year window from now. So I would advocate that completely. So you want to look at this, revisit this again, go see the videos, just type in 3 bucket strategy on my channel, and that'll walk you through what does that mean. This scenario, what we're going through right now, is a perfect setup as to why you want to have some of your money in cash, to have withdrawals coming out of cash and not out of a declining or a negative fund or a negative security. It's the single biggest thing, besides you spend more than you thought. Doing withdrawals in a negative environment is one of the single worst things you can do to advance your portfolio to zero. It accelerates the momentum of your portfolio to zero, unlike anything else. So be careful about that. Okay, so what has happened and what is Trump up to? So let's have a look at this here. So in 2016, Trump looked at China and said, we have to fix the trade imbalance. Just going to check them. Okay, I'll get to you in a second, Chung. So when Trump was elected, Trump looked at the trade imbalance between China and the United States and said, we have to fix this. And it was 347 billion in 2016. And by 2019, it was 308. So there was an improvement of $39 billion that the United States shaved off of that trade imbalance with China and the United States. That's good for the United States. But the problem was they had to do more trade with other countries because China was, playing rough with the United States, and the United States is playing rough with China. And so the United States said, well, we've got to go to other countries to get the products. And so in 2016, the rest of the countries around the world had a $502 billion trade deficit with the United States. But by 2019, it had gone up by $75 billion. So what am I talking about here? Get rid of this one here. Well, I'll just finish my notes and I'll come back to you. So what happened? So imports from China decreased due to the tariffs. U.S. businesses shifted sources to other countries like Mexico, Vietnam, India, and then a strong consumer demand and a strong dollar made imports attractive overall. So let's hide that. So in 2016 to 2019, they tried to improve this trade imbalance with China. And as a result of going elsewhere around the world, because they didn't have trade agreements negotiated since the Second World War, they just ran up imbalances with other countries around the world. So Trump remembers this coming back into office, and he says, we did reasonably well against China the first time I was here, but we got really crushed by other countries because we didn't negotiate any trade agreements with other countries. So the first order of business on his mind is renegotiate all the trade agreements around the world. So we got China sort of understanding how to negotiate trade imbalances with them, but around the world, we need to fix that problem, because if we do, that'll help. So that's what's going on in Trump's mind, is make deals all over the world, have better trade agreements all over the world. So what you see right now with this sort of business, this show in front of the White House with this board that was kind of ridiculous, just trying to illustrate a point, I guess he was trying to do. But the whole point of this was, I'm going to create all of this noise around we're going to have a trade war so that I can get you to come to the table and negotiate. That's all this is all about. So this market of what you're seeing right now, which is this one here, I'll give you this one here, where the market has declined so dramatically. It's not so dramatically. You've all seen declines greater than this. This is being caused completely politically driven. It's not being driven by companies not being able to compete well. This is just simply a matter of a country, the United States, deciding they don't like the status quo. Let's change that. So we are going to have to endure these market conditions until countries around the world sign new trade agreements. And you can expect that Canada will sign a trade agreement shortly after the election. Whether that takes the summer to get through that, I hope not. But I would expect that by the fall, all of the countries that are not all, but some will hold over and say we're not going to trade. We're not going to do anything different. The major countries around the world will sign new trade agreements with the United States, and the markets will go back to the way they were. In the interim, what you'll likely see is rate cuts in both the United States and in Canada because we are going to have inflation. Um, there's no question about it. Things are going to cost more money. And in order to stop inflation from going up, they're going to have to cut rates. And that's going to be, they're going to have to raise rates later on. But over this short period of time, you can expect to see rate cuts. So I would say to you, if you've got a portfolio now that's suffering, try not to worry about it too much. And when I say that, let me show you something specific. I don't have it. I think I do here. Let's have a look here. Gold. If you've got gold in your portfolio, look what's happened to your gold in your portfolio. It's gone up on a ride. It's skyrocketed since 2024. It's gone not straight up, but it's gone up remarkably well. Why? Because the world saw that there was going to be a trade war going on. If you look here, fixed income portfolio. So these are bonds, right? Year to date, they're getting just over about 2% or more on a bond portfolio. So you're not really experiencing too much of a negative decline here. If you look at financials, this is financials all the way back to 2017. So you could see what happened to financials even with Trump in his first presidency when there were tariffs, that you can only see some spots here where they declined, where everything declined, the worldwide, that health crisis that happened in 2020. Financials do well both in great economies and poor economies. So yes, you're going to see these fluctuations, but financials are good, gold are good. Here's the rest of all the sectors you can be in. Really busy slide, but why am I showing you this? I'm showing you this because despite these sudden drops, like big sudden drops, markets have run up every single time. I'm just showing from 2017, but if you go back, way back, go back to how many of you, I don't know, show of hands, have or remember the 2000s when the tech bubble bursted? I do. I was working at Nesbitt Burns at the time. And the markets have run up dramatically ever since then. So what I would say to you is this. Probably tomorrow is going to be a very ugly day. So much so that I think you'll see some markets will probably be shut down a couple times during the day. That's my expectation. But you have to be prepared with the idea that some of your money is not needed, or most of your money isn't needed for the next 15 or 25 years. So you need to prepare some of your portfolio. If you don't have, I would get on the phone with your advisor and start talking about your portfolios right away. Where have you experienced great losses? And examine those losses. Where has it been too bad? And if you wanted to move some of your money into money market or fixed income portfolio and take a small loss to protect yourself against what might be a big unknown, I don't see an argument against that. But if you have some pretty serious declines right now, you have to reconsider whether or not you want to crystallize those losses and find out whether or not it's detrimental to your retirement. Why do I say detrimental to your retirement? Let me go back to the slide here. Do you all remember me telling you about your retirement zone, the first 5 years before retirement and the first 5 years of your retirement? So it's not the first 5 years before, it's the 5 years preceding your retirement and the first 5 years of retirement. This is where you want to minimize negative returns. If you are in that timeline, then you have no business being 70% equities, unless you have so much money that you don't really worry that much about markets. And there are a few of those people, but most people that I come into contact with have, let's say, between $1 and $3 to $5 million ready to go for retirement. And so you kind of have no business being 70% equities. That is a recipe for disaster. If you're in that kind of timeline, you should not be 70% equities. You should really be thinking you don't have time to recover a severe negative return. So reconsider how you're doing that. Now, the best thing you should do is get a financial plan right away. Why do I say that? Because when you look at this here, this plan just shows you one of the things that we do in a plan. I can't highlight like I do in a video here, but I can show you this. If you look down just one of those columns and you look at the rate, that represents the rate of return that we're modeling for this person's plan, and it's 4.6%. So why is that important? It's important because if your portfolio, so your retirement plan, can last, so the longevity of your money can last throughout your lifetime and not have to sacrifice any lifestyle expenses and only have to get 4.5% rate of return, that's a good sign. If you need 7%, 8%, that's not a good sign. So get a plan done, get a rate of return that shows what is the minimum that you need. In this case, that wasn't a minimum. When we talked about it, they just didn't like seeing 2 or 3% on the board. So I showed 4.6. But this idea that you want to get a retirement plan done with an illustration showing you what's the lowest rate of return that you need in order to make sure all of your lifestyle needs are met. Simple. And then you can be assured that in times like tomorrow and the times like last Friday and this first quarter of the year, you can just take a deep breath and not be too worried about anything. Let me check your comments here. Okay, I'll try to get to some of these. So Chung, about so by the way, how was that so far in terms of a recap, what Trump is thinking, the predicament that we're in with Canada, and the fact that we don't have really a prime minister that's ready to negotiate because there's an election coming. So let's see here. Chung is saying, I'm going to see if I can put this up on the board, which I can. Yes. What are your thoughts on Pierre Poilievre, you were mentioning, implementing zero capital gains when reinvested back into Canadian assets? If this is true, it seems better than 1031. So what do I think of that? I think it's awesome. Awesome. I mean, if you are a real estate investor, if you've got a cottage, you've got a business, I think this is awesome. A lot of people who are sitting on real estate right now, when I'm doing plans with people, one of the conversations, especially when you have real estate, one of the questions is, what do you want to do with your real estate? Do you want to sell it before you pass away? Do you want to give it to your kids when you pass away? What's the plan here? And so that's always takes up one meeting, usually, as we were just talking about what do you want to do with real estate? And for the most part, the problem is the capital gains. And so this idea that the zero capital gains solves that problem for so many people, it's an awesome thing. And I'm envious of the United States having this 1031 exchange. If people don't know what that means, you have a certain period of time. I don't remember what it is in the United States, but you have a certain period of time that when you sell like a real estate project, as long as you don't receive that money personally in your hands and you roll it into the next project within a certain period of time, you don't pay any capital gains. And I think that's great. I think Canada Revenue is going to get their tax. There's no question about it, but they're just pushing that down to the point when you pass away. So I love it. Especially if you can put it in a trust and you just keep rolling that over, that would be awesome. So I think it's a great idea. What are your thoughts, Ryan? This is awesome. Okay. This is $1 million question, Ryan. Well done for you. What are your thoughts on borrowing to invest at this time? I have 20 years until retirement with extra cash to invest, but I feel now would be a good time to invest as a must as possible. Okay. This question gets my juices going because I've done leverage for clients in the past. Leverage should not be done for everybody. If you're behind and some advisor says you should do leverage because you're behind investing, I think it's the wrong thing to do for many clients in that situation because typically when people are behind, when we say behind, they don't have enough money for retirement. and they take on risk like this, they also don't have the capacity to pay that loan off if things go the wrong way. And then they wake up every morning being wildly in debt, um, and not enough money to do the other things that they want to do with their kids, with their family, with themselves. And especially if any medical issues arise or somebody loses a job, like it can be a real spiral down for a lot of families. So I would say you have to be the right person to do leverage right now, or leverage in any time. Now, if you were to look back in history and said with 2020 vision and say, had you had um, at the bottom of the crisis, the crisis in 2008 or in 2020, and you had leveraged your home, you probably would have been retired by now. But that is because you had this steel nerves. With 20 years in front of you, I'd be cautious about when to start this. Yes, you've got a lot of runway in front of you, but at the end of the day, you still have to afford that payment. And if you lose your job, how long are you going to be able to continue making that payment? That's the problem here. So if you're doing leverage with money that you have cash sitting on the side that you can pay for that loan for the next 2 years, maybe that's not a bad idea. But if you're paying for that leverage position, I hope everybody understands what I'm talking about leverage. What Ryan is saying here is the market is low. So the things that you would normally want to invest in are cheap. They're on sale. So go out and take a loan, and you might have to collateralize your home or some other asset in order to get that loan. And then you go and buy those securities, whether it's stocks or ETFs or whatever you're buying in the market, which is a highly risky move. And it's done every single day. But some people shouldn't do it and some other people should. So Ryan, if you have cash where you've got enough cash for the next 2 years to make those payments, then maybe that's not a bad idea. I'd question what you're buying. That would be the next thing. So if you're betting that you thought the US economy was going to go up, so the S&P 500, for instance, or where you were betting that the NASDAQ was going to recover, a little bit more riskier. Certainly, I believe that technology is going to lead the way. And right now, it's a very bumpy ride. For the last 5 years, it's gone up, it's gone down a few times. So I would say it would be a one-off thing that I would talk. If I was your advisor today, I'd be saying, okay, what do you have in mind? What is your expectation? What's your job? What are you doing for a living? What's the likelihood of you losing your job? Now, why I'm saying this is because I talk to people every day. I'm doing planning every day. And I have people that tell me they've just lost jobs. I have people that did plans with me and then call me back and say, I just lost my job. I need to change my plan. And they lost their job because of the tariffs. Their company saw tariffs coming and said, we need to cut our workforce. I talk to CRA, Canada Revenue, every week for clients, okay? And I had the person on the phone talking to me, telling me they were being laid off at CRA. So I would just simply say, be careful about leverage. It can work in your favor, especially with a long timeline. But if you lose your job and you have limited access to capital, it's probably not a good idea. So just looking at some of the other, so some questions around, like Billy, I'll just put yours up. Worldwide recession now predicted at well over 50%. If you look at 2020, we were in a technical recession then. The governments were spending their money. They were asking to stay home, and they gave us loans to stay home. 2008, 9, and 10 was a recession. It took 5 years for people to recover from that worldwide financial crisis. Is a recession a bad thing? Not really. Markets were really, really high. I don't think anybody here is on this call now would argue against that the Nasdaq was not high. I mean, it was high, and everybody was going, you know, Google eyes for Google and the Magnificent Seven because of AI. And while AI is going to be leading the way and it's going to changes my business, there's so many things about my business that AI does for me now that it didn't before. And so is it going to be useful? Yeah, but we're going to have to go through, it's my belief right now, very much in the way that, like, we're going through a technological change again. And there are going to be companies that are not going to survive this. 3 years from now, some companies are not going to be around. If you look at when I'm old enough to remember typewriters, when typewriters, everybody's on the typewriter, and then we went to a keyboard, the word processor. People had to learn keyboarding at high school and so on. And then the computer came in, and we stopped using calculators. We stopped using paper. Kids have stopped learning cursive, how to write in school. They don't know how to write their name on a check. And when they'll even ask you, what is a check? We did away with VCRs and beta. We have cars that are driving by themselves now. We have rockets that seemingly can go into space pretty on a regular basis now and not get in any trouble. We have instant communication with just about anyone, anywhere in the world. We now have blockchain and cryptocurrencies where we can purchase things not through the banks. It's a pretty remarkable time that we're living in. And the way in which that technology is advancing so fast that the way that we're doing things today is not going to be the same way 5 years from now, 10 years from now. We're not going to be anywhere close to who we are today. Like, my firm belief is within 10 years, I don't think any of us will be driving our car by ourselves. I think that's all going to be, your car will be picking you up and bringing you wherever you want. So I think a lot of the ways that of us being in recession, largely, I think, is the new world order of reorganizing how we're using technology and how we're dependent on one another, how we need one another in many, many ways. This idea that, Trump's saying he doesn't need anything from Canada. We're the second largest trading partner with the United States. It's an absurdity. They need all of our electricity, millions and millions of barrels of oil every day. They certainly need us to come into their country and do commerce with them. So to say that the second largest trading partner is not really that important to you, it's kind of absurd. So this is a time where we're just going through this period where we're going to have to pay very attention to which companies are adopting AI and adopting technology and changing, and which companies are not, because I believe we're going through another shift in the way that technology has shifted so many times for us. I think we're right on the cusp of all of that changing again. Like, I'm really excited about education for kids. I really believe that this idea of I'm sorry to say for teachers, but I really don't see how us trucking our kids to school and being in these schools and having a teacher teach, I really think that's not going to work anymore. I think very soon, within my lifetime, I think we're going to have where our children will have their own virtual AI education avatar, and that avatar is going to speak a language that child speaks. That avatar will learn how that child learns and will educate them in a way that child's going to actually be able to learn faster. They're going to be able to choose whether it's a male or a female and a voice, everything. I think that's the way education is going to go. And you think how fast kids are going to go through grade school and high school. And the thing that bothers me with that system is that they'll lose this connection, right? The networking of being with other kids. So I think it's going to be something that is not just going to affect people my age who have traditional jobs that are probably won't be around in certain aspects. But I think the teaching is going to be changing completely. We'll see. Okay, so with that in mind, I don't think I've got anything else. 40 minutes on the fly. I was actually going to record this video tonight, and I thought, you know what? I think you probably would want to hear from an advisor today, and just fire your questions at me, and just to hear. Like, after all, I'm an advisor, but I'm a human being, so I watch my own money and I take care of my own life, and I'm taking care of my clients' money. And these days when these things happen, I'm just reminded of all the events I've already been through with clients, and back in 2000 and 2008 to 2010 and 2018 and 2020, 2023, 2025. Like, we've had market decline. It's going to just be a passing thing, and we'll figure it out. Okay, I'm going to call it an evening. I want to thank you so much for joining me today. I look forward to seeing you in all the other videos that I'm doing. Again, put your comments below. I want to hear what you have to say. And I'm going to leave you this one last question. Is your withdrawal strategy protected from market volatility? Just so put your comments, how are you protecting your money from market volatility today? That would be an interesting thing for other people to hear, how you're doing that. Certainly a financial plan helps you to figure out how to protect your money so that you can retire comfortably and not worry too much about what you're going to see in the coming month or two. With that in mind, thanks again for joining me this evening. It was great to see you as always, and I look forward to seeing you in future live streams as well. Take care. Be well.